Welcome back to the Psychology of Investing, the podcast where we uncover the hidden mental habits that shape financial success. Today's topic is one every investor eventually struggles with: the biggest timing mistakes investors make. Joining us is Dr. Adrian Cole, a behavioral finance expert, veteran investor, and researcher who has spent 3 decades studying why intelligent people repeatedly time the market. Dr. Cole, why do so many investors, even experienced ones, seem to buy at the wrong time and sell at the worst possible moment?
That's one of the greatest paradoxes in investing. People assume losing money comes from not knowing enough about stocks, but more often it comes from not understanding themselves. The market is less a battlefield of numbers than a mirror reflecting human emotion. Think about it. When headlines scream that a stock is unstoppable, people feel safe buying because everyone else is buying. Ironically, that's often when risk is highest. Months later, after prices have fallen and fear dominates every conversation, those same investors sell, not because the business became worthless overnight, but because their emotions became unbearable. One of my favorite sayings is, "The market rewards patience but charges interest on panic." Most investors don't lose because they're unintelligent. They lose because they mistake emotion for information. Another common mistake is waiting for the perfect moment. They'll say, "I'll invest after the next correction," or "I'll wait until things become clear." But clarity usually arrives after prices have already moved. Certainty is expensive in investing. There's also recency bias. If markets have been rising for months, people convince themselves they'll rise forever. If markets have been falling, they imagine they'll never recover. Yet history tells a completely different story. Markets move in cycles, but human emotions react as if today's headlines will last forever. I once spoke with an investor who proudly admitted he'd bought at the peak of a bull market because his taxi driver recommended the stock. A year later, after a major decline, he sold everything and vowed never to invest again. His investments hadn't defeated him. His psychology had. The investors who quietly build lasting wealth usually aren't predicting tomorrow. They're preparing for 10 years from now. They understand that time in the market consistently beats trying to perfectly time the market. Instead of asking, "Is today the perfect day to invest?" ask, "Am I building a system that works regardless of what the market does next?" That single question changes everything. Discipline outperforms prediction, consistency outlasts excitement, and emotional control remains one of the highest return investments you'll ever make.
What a powerful reminder. The market isn't just a place where money changes hands. It's where emotions are constantly put to the test. If today's conversation helped you see investing from a new perspective, don't keep it to yourself. Share this episode with someone who could benefit from it. Subscribe for more insights into the psychology of investing. And remember, the investors who build lasting wealth aren't the ones who predict every market move. They're the ones who master themselves. We'll see you in the next episode.